You spent years in school learning math, science, history, and maybe even how to dissect a frog. But there's one subject that affects almost every decision you make as an adult, and most people were never taught it properly. Money. Have you ever wondered why someone can earn a great salary and still struggle to pay bills? Or why a small financial habit that seems harmless today can quietly cost tens of thousands of dollars over time? That's because school taught us how to earn money, but not how to manage it. Think about this for a second. Spending $5 a day on coffee, snacks, or small treats doesn't feel expensive. It's just a few dollars here and there. But over a year, that adds up to about $1,825. If that same amount were invested every year for 30 years, it could grow into more than $180,000. Same money, completely different outcome. The difference isn't necessarily income. It's knowledge and behavior. Most people believe the solution to financial problems is simple: make more money. And while earning more can help, it doesn't automatically create wealth. You've probably seen people get a raise, buy a nicer car, upgrade their apartment, and then wonder why they still feel broke a few months later. Making money is only half the story. Keeping it and growing it is the part that changes your life. Two people can earn the exact same paycheck. One builds savings, invests consistently, and gradually becomes financially secure. The other spends everything that comes in and stays stuck living paycheck to paycheck. The difference is rarely luck. It's the small choices repeated over and over again. And that brings us to one of the biggest money truths nobody explains. Most financial problems don't come from one giant purchase. Yes, an expensive car or a luxury vacation can hurt your finances, but for many people, the real damage comes from the small purchases they barely notice. A streaming service you forgot about, food delivery a few times a week, a snack every time you stop for gas, a shirt that was on sale, so it felt like a bargain. Individually, none of these seems like a big deal. Together, they can quietly drain hundreds or even thousands of dollars every year. Companies understand this extremely well. Grocery stores place impulse items near the checkout for a reason. Online stores use messages like "only two left" or "spend a little more for free shipping" because urgency makes people spend more. This doesn't mean you should never enjoy your money. The goal isn't to become obsessed with every dollar. The goal is to spend intentionally. A simple rule that helps many people is the 24-hour rule. If something is not a need and costs more than $20, wait a full day before buying it. You'd be surprised how often the urge disappears. A budget isn't a punishment. It's simply a map. If you don't know where your money is going, you can't control where it ends up. The people who build wealth are not always the highest earners. They're often the people who notice the small leaks before those leaks sink the ship. But saving money is only the first step. The next truth is about debt, and this is where many people get confused. We're often told that all debt is bad. That's not entirely true. Debt is a tool, and tools can be used well or used poorly. A mortgage can help someone buy a home years before they could pay for it in cash. A student loan can help someone gain skills that increase their earning potential. That's why people sometimes call these forms of debt good debt. But high-interest consumer debt is a different story. Credit card debt is especially dangerous because it creates the illusion that you can afford something simply because you can buy it today. When you carry a balance and only make the minimum payment, a large portion of your payment goes toward interest rather than reducing what you owe. Imagine buying a $1,000 item with a credit card charging over 20% interest. If you make only the minimum payments, you could end up paying close to twice the original price by the time the balance is finally gone. And by then, the item you bought may have lost most of its value. Before borrowing money, ask yourself one question. Will this help build my future, or will it simply make today more expensive? That single question can prevent years of financial stress. Another money truth almost nobody learns in school is how powerful a credit score can be. Think of your credit score as a financial reputation. It tells lenders how reliably you've handled borrowed money in the past. A strong credit score can help you qualify for lower interest rates on cars, homes, and other loans. A weak score can cost you thousands of extra dollars even if you're buying the exact same thing as someone else. Imagine two people buying the same car. They have similar incomes, similar jobs, and similar expenses. The only major difference is their credit score. One gets a lower interest rate and pays less every month. The other pays significantly more for the same vehicle. That one number can quietly affect your finances for years. The good news is that building good credit is not complicated. Pay bills on time. Avoid borrowing more than you can realistically repay. Keep credit card balances relatively low. It's a lot like brushing your teeth. One day doesn't make much difference, but consistent habits over many years create healthy results. Now let's talk about something even more important than saving: making your money grow. Saving money is essential because it creates a safety net, but saving alone is usually not enough to build long-term wealth. The reason is inflation. Over time, prices rise. Groceries become more expensive. Rent increases. Gas costs more. If your money sits in a basic savings account earning very little interest, its purchasing power may slowly shrink. That's where investing comes in. Investing allows your money to work on your behalf. The easiest way to think about it is like planting a tree. At first, growth seems slow. You water it, wait, and nothing dramatic happens. But given enough time, that small seed can become something much larger. One of the most powerful forces in investing is compound interest. The term sounds complicated, but the idea is simple. Your money earns returns, and then those returns begin earning returns too. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, becomes larger, and grows faster. That's exactly how compound growth works. And here's the part most people discover too late. Starting early is often more important than starting with a large amount. Someone who invests a modest amount beginning at age 25 can end up with more money than someone who starts at 35 and invests a larger amount every month. The earlier investor has something the later investor cannot buy back: time. Time is one of the most valuable assets in finance. This is also why employer retirement matches are so important. If your company offers to match part of your retirement contributions, that is essentially free money. Failing to capture the full match is often like turning down part of your compensation. Another area that confuses many adults is taxes. Have you ever looked at a paycheck and thought, wait, where did all my money go? Your salary is not the same as your take-home pay. Before the money reaches your bank account, taxes and other deductions are often removed. Many people also misunderstand tax brackets. They think moving into a higher bracket means all of their income gets taxed at the higher rate. That is not how the system works. Only the portion of income that falls within the higher bracket is taxed at that higher rate. Understanding this can help you make better decisions about raises, bonuses, and career growth. Let's also talk about mortgages, because this is one of the biggest financial commitments most people will ever make. In the early years of a mortgage, a surprisingly large portion of each payment goes toward interest rather than paying down the actual loan balance. That means extra payments made early in the loan can potentially save a significant amount of money over time. But perhaps the biggest mistake is buying the largest house a bank says you can afford. Banks calculate what you may qualify for, not necessarily what will give you the best quality of life. If most of your paycheck goes toward housing, you may struggle to save, invest, travel, or handle unexpected expenses. That situation is often called being house poor. Sometimes the smaller home creates the larger life. Then there's insurance, which many people dislike paying for. It can feel like money disappearing for something you might never use. But insurance is not designed for small inconveniences. It exists to protect you from rare events that could wipe out years of savings. It's a financial safety net. You hope you never need it, but you're grateful it exists when life takes an unexpected turn. Now let's talk about the raise that disappears. Getting a raise feels exciting. Most people tell themselves they'll finally save more money. Yet a few months later, their bank account often looks almost the same. This is called lifestyle inflation. As income rises, spending tends to rise with it. A better phone, a larger apartment, more takeout, more subscriptions, more convenience purchases. None of these decisions seems terrible on its own. The problem is that they often expand just enough to consume the extra income. Before long, you're earning more, but not feeling wealthier. A powerful habit is to increase your savings before increasing your lifestyle. The next time you get a raise, automatically direct part of that increase into savings or investments first. Even saving half of every raise can create a massive difference over a career. The people who become financially secure are not always the ones with the biggest paychecks. They're often the ones who consistently keep a meaningful portion of what they earn. And that leads to the final truth: what financial freedom actually looks like. When people imagine being rich, they often picture luxury cars, huge houses, designer clothes, and expensive vacations. But appearances can be incredibly misleading. Someone driving a luxury car might be overwhelmed by debt. Someone wearing simple clothes might have a healthy investment portfolio, a paid-off home, and the freedom to choose how they spend their time. Real wealth is not about looking rich. It's about having options. Can you handle an emergency without panic? Can you sleep well because your bills are covered? Can you take time off work if a family member needs you? Can you say no to a job you hate because you're not desperate for the next paycheck? That is what financial freedom actually looks like. Money cannot solve every problem, but it can buy something incredibly valuable: peace of mind. So let's remember the biggest lessons. Small daily spending matters more than most people realize. Not all debt is bad, but high-interest debt can keep you stuck for years. Your credit score has a powerful impact on your financial life. Saving protects you, while investing helps your money grow. Time is one of the greatest advantages an investor can have. Understanding taxes and mortgages can save you from costly mistakes. And earning more money does not automatically make you wealthier if your spending grows just as fast. Most of these ideas are not complicated. The surprising part is that millions of adults were never formally taught them. So here's a simple challenge for the next 7 days. Track every dollar you spend. Don't try to change your habits yet. Just observe them. You may be shocked by where your money is actually going. Because once you know where your money goes, you can start telling it where to go. If you learned something new today, make sure to like the video and subscribe. Every week, we break down money in a simple, practical way that's easy to understand and useful in real life. The sooner you understand how money works, the sooner it can start working for you. Thanks for watching, and I'll see you in the next video.